live analysis first.
All right,
and then
let's do this.
the Q&A at the end, because we'll have more questions regarding the markets as well.
Okay, let's do that. Okay, so I will see what I see in the markets. All right. So you wanted to analyze gold in the first place and whether gold will go up or not. So when I watch the charts, I always start with daily charts. So daily chart is my main analytical framework. I don't trade on daily charts. I trade on 30-minute charts and 5-minute charts. But daily chart is what I start with. Okay, so first of all, I need to place here 3 references, which are 3 moving averages. Why is that? Why do I even need moving averages? So, well, basically I don't, but what do I want to see? It is the moment when the asset, in our case gold, aggregates around important long-term references. So for example, take a look here, 200-day moving average, the long-term level. And here we also have 20-day moving average and 50-day moving average, right? And the gold had started to move exactly from this level. So if you ask me a question of what will happen with gold, I would probably say that it will continue moving down. Until what level it will continue moving down. So I keep in mind the level of 1885, 1888 approximately, so which is the previous low, which is low of the previous period from August 2023. That's a support level. Well, it's not a support, it's extremum by definition. I don't like the word support in here because we don't know that it is support until we actually see that market goes up, right? I would say extremum to be fair. Why I am thinking that gold will continue moving down? So here are 2 reasons. First of all, gold has a negative correlation with the American dollar index. And you see what happens with American dollar index with DXY. It's moving up. Why is it moving up, basically? It's moving up because long-term bonds from the United States Treasury are plummeting. They're moving down. So let me see the picture. Okay, for example, let's see 30-year Treasury bond yields. So if you take a look at this chart, this is the yield of 30-year Treasury bonds of the United States, and you see that it's moving up. So in other words, this market is plummeting, bond prices are moving down, and yields are moving up. Whenever yields of bonds of any country are moving up, so money starts to flow into this market. Why is that? Because imagine, for example, in August, in July, yield of 30-year Treasury bond was 4%. Now it's 4.7%. Imagine a big capital sitting in a hedge fund or investment fund. Where the money will go? Of course, it will go to American dollar rather to any other currency because the yield is greater. So you want to invest more money in that, right? And that's why they make conversion operations. They sell their euro, sell their British pound, sell their Japanese yen to invest in the American dollar. And that's why we see those trends of diminishing euro USD, diminishing British pound versus USD. You see this trend? They are moving down because of the moment of strengthening U.S. yields of U.S. bonds. Okay, what about Europe, for example? For Europe, the situation is less intense. So for Eurozone, for example, let's take 10-year German yields. So basically, yields of bonds represent the yield of a currency. In other words, 2.78, but that's not the number that we're interested in. That's the dynamics. The dynamics is also increasing, but the dollar is much more interesting. So it's much more aggressively increasing its yield, and that's my money goes to American dollar. For example, if you Google British pound, for example, UK, right? British pound, UK 10-year bond yield, you will see a completely different picture. All right? That's 10-year gilt, the so-called 10-year gilt, the debt market of the of the United Kingdom. It's moving down, basically. So in other words, the money is not going to the British pound, it's going to American dollars. So everybody sells their British pounds and buy American dollars because yield is greater for American dollar. It's increasing, basically. That's why gold is moving down, because the USD, DXY is the American dollar index, and the American dollar increasing across the board. So gold has a negative correlation with that. If you take a look at it.